In this chapter, we shall take a brief look at the trading mechanism of futures and options on exchanges, including various types of orders. However, the best way to develop an understanding on the trading mechanism would be to watch the screen and observe trading. Markets around the world can be classified into two main broad categories, and that's based on the method of booking a trade. One is an open outcry, the second are the electronic markets. Open outcry is the way of communication between professionals on an exchange, which involves shouting and using hand signals to transfer information about buyers and sellers and their orders. In an open outcry, the trading takes place in a large hall known as a pit, where members are present and contracts are traded between the buyers and sellers, of course, through the brokers. Now, one quick example of an open outcry market would be the erstwhile trading mechanism used at the Bombay Stock Exchange. Now, moving ahead and coming to the electronic markets, in case of electronic trading, there are screen-based brokers dealing terminals instead of the trading pit. FNO in India is electronic in nature with the bids and offers and the quotes given by the buyers and sellers all accepted and traded continuously on to the platform which is provided by the exchange. All the derivative exchanges in India provide a fully automated screen-based trading platform for both index FNO and stock FNO. These trading systems support an order-driven market and simultaneously provide complete transparency of trading operations. Derivative trading is similar to that of trading of equities in the cash market, cash segment. All these exchanges have developed software for the FNO market to facilitate efficient and transparent trading in FNO instruments. Key participants within the trading system. One is your trading member. Now, a trading member, in very simple words, is the person who is your broker, the person who puts the trade in on behalf of the client. A quick one here, which is not on the screen. A client is also known as a participant. So the person for whom the trader is putting the trades is also known as the participant. A trading member as a broker might also have several sub-brokers. Those sub-brokers are known as authorized persons. They trade under the license of the trading member. So these were just a couple of points which are not there on the screen. Now coming on to the clearing members and the various types within that. We had discussed this within the currency derivatives module as well. So let's just quickly revise through this. So a trading member, a trading cum clearing member is someone who may clear and settle their own proprietary trades, who will also trade and settle the trades of their clients and can also settle trades of or clear trades of other trading members and other custodian participants. So that's a trading cum clearing member. A trading cum clearing member would first of all trade on their own behalf, trade for the clients, and can settle and clear trades of the entire ecosystem. That's a trading cum clearing member. A professional clearing member cannot trade. A professional clearing member is someone who would clear trades of other trading members. They are typically banks or custodians who become a professional clearing member, and they clear and settle for trading members as well as custodian participants. That's a professional clearing member. A self-clearing member is a person who trades only on their own account. So a self-clearing member is also a trading member on the exchange. Now, such clearing members may clear and settle only on their proprietary trades and the trades which come along through their clients, but cannot clear and settle trades of other trading members. So these will be the various constituents of a trading mechanism, ranging from the trading member, who is the broker, authorized person, who is also the sub broker, participant, who is not no who is the person who, for whom the trading is happening, be it purchasing or selling, and the three different types of clearing members. Derivatives trading occurs on all working days and it runs from 9:15 a.m. to 3:30 p.m. SEBI allows exchanges to extend trading hours from 9 a.m. to 11:55 p.m. provided you have the exchanges have adequate risk management systems in place. In terms of the corporate hierarchy for the FNO trading software implemented by the exchange, the senior most person is the corporate manager. A corporate manager can perform all the functions such as order and trade related activities, receiving reports from all branches of the trading member firm, and also dealers of the firm. Along with this, he or she can also define exposure limits for the branches of the firm. This facility is available only to the corporate manager. One level lower is your branch manager. This person is placed under the corporate manager. The branch manager can perform and view orders and trade related activities for all dealers under that branch. A dealer becomes the lower point of the hierarchy. A dealer can basically only see and view their own orders which they have placed and does not have access to information on other dealers who are either part of the same branch or are part of another branch. So the hierarchy within the trading software is corporate manager, who can view all the activities by all the branches by all the dealers, can pull reports, can do anything that's required, to see from an administrative standpoint for the entire software for the on the platform. A branch manager, just like a corporate manager, has access to everything, but only at the branch level. So you have multiple branch managers based on which branch we are looking at. A dealer has access only to their own terminal and only to their own trades. That's your hierarchy for a trading software. So a day order refers to an order which will be live or active within the trading system for a single day. In case that order is not executed by the end of the day, it will stand cancelled. Immediate or cancel as an order has to be executed immediately, can get partially executed, and the portion of the order which is not executed will expire and will sort of be lapsed within the system immediately. Two more types of orders. Limit order puts in a condition that at a particular level of pricing, either buy or sell. So the execution will only happen till the time that pricing limit is not breached. For example, if it's a buyer, the person puts in a price. If the prevailing price is higher than the current or the price which was the limit price, the order will not get executed. If the price is lower, yes, the order will get executed. That's for a buyer. Similarly, for a seller, if the price is lower than the limit price, then the order will not get executed. In case the price is higher, the order gets executed. That's your limit order. Similar to that, we'll move to stop loss order. So a stop loss order triggers only when a particular price a price level gets triggered. which means a stop loss order would move into a limit order or a market order provided a particular price level is breached. So stop loss is basically, as the name says, is to control your losses or control your exposure beyond a particular price. The person just wants to close out on their position. A market order is basically go ahead and execute the order based on the volume that's available at the prevailing market prices. So that's a market order. Order matching in the trading platform happens first of all based on the best available price. So the first element that is looked up is the price. In case the price is the same for from two specific people who have quoted, then what gets looked up in terms of what should be executed is going to be the time whose order came in first. In case there's a tie even on the time front, then you will be looking at partial matching, which means if required, only a part of the order will be getting executed and not the entire order. And it could be so that multiple trades can create the entire order and not a single specific trade. So price bands are put into place to ensure that there are no erroneous orders which are punched into the derivatives market segment, because this involves a lot of leverage and can obscure the market, and hence it is important that price bands are put into place. Now, the price band for index futures as well as stock futures is 10%, and earlier for that price band to move, the requirement was 25 trades. Now you need 50 trades in a particular direction at the helm, or the ceiling or the floor of the price band for that price band to move. We'll be looking and discussing more about enhanced dynamic price band in the next slide, but the required trades over here which I mentioned is specifically for the enhanced dynamic price band which was implemented in May 2024. So I mentioned about the 50 trades on the previous slide. Additional to that is those trades should be coming in from 10 different traders. It should not be a single trader who has punched in 50 trades, to ensure that there's a lot of market consensus in terms of pushing either the ceiling or floor further away from the 10% limit which was at the start of the day. And it should be coming in from 3 brokerage firms at least on each side, which is buy and sell. Previously, these numbers were 25 trades and 5 traders. Second is when you're talking about enhanced price band criteria, it's about the synchronized movement, which means, say at the start, if the price was 100, then the floor is 90 and the ceiling is 110. That's the 10% limit. If the if the ceiling moves from 110 to 115, then the floor also moves from 90 to 95. So it's synchronized. The lower band or the higher band would also move whenever the bands are getting breached and moving ahead or up. Third point around enhanced price band criteria is the extended cooling periods. So once a particular price band is reached, there's a cooling period. That is, there is nothing, a wait time, which will, which ensures that, the traders can think through properly for 15 minutes. And after every increase which happens on the stock futures or the index futures, the subsequent wait time or the cool off period also increases. So the first cool off period is 15 minutes, the second one 30 minutes, the next one 60 minutes. This is a time when you cannot execute any trades. You are waiting for the band to be stretched out and extended, right? And finally is sliding price bands, which is uh, so, So sorry, I missed on the synchronized movement. Synchronized movement was around the bands move in the cash market and the F&O market together, whereas the sliding price bands is the point wherein the price band on the lower end and the higher end move together. So when 110 becomes 115, even the 90 becomes 95. So that earlier bit was around the sliding price bands, and the synchronized movement is around the markets, two markets, which is the cash market and the derivatives market. The bands on the same stock on the index move together. Was it determined which stocks should be part of derivatives trading? It's determined by these four conditions. One is the market cap of that stock should be uh, in the top 500 for all the listed stock. Does it mean that all 500 listed stocks will be traded in the derivatives exchange? No. All four conditions need to be satisfied for the stock to be part of the derivative segment. So let's look at it. So one is it should be part of the top 500 stocks as per your daily market cap. And that daily market cap again should be in the top 500 for a period of 6 months. Second one is your order size requirement, which means the order size should not be less than 75 lakhs for again the 6 month period. What it means is your book entire build and the trading which happens should not be less than 75 lakhs with a median quarter sigma order size, which means what does the median quarter sigma order size mean? So if you have two just for the sake of simplicity, the probability distribution curve looks something like this. If I have to put up all the orders ranging from smallest to the largest, there will be a particular string wherein it will be one, you'll come across at the midpoint in terms of count to be at median. Now this median position, if I have to go quarter sigma, so 1 sigma standard deviation on a probability distribution curve gives you close to 66% coverage of the distribution. Likewise, one quarter sigma of that specific order size, right? These are all your order sizes put up, should not be less than 75 lakhs. So that's basically a condition around volume. This was a condition in a way around market cap. Third thing on the position limit. Similarly, the market-wide position limit should not be less than 1500 crores on a rolling basis, which means there should be open positions not less than to the extent of 1500 crores in terms of the trades which are happening over a period of time through the entire day, which means your stocks cannot be something that is held largely held by the promoter or some other entities which cancel this out to become free float. So basically, the stock should be a free float stock. And finally, around the delivery value. So average daily delivery value should be so and so for the last 6 months. The reason for that is the stock should not be something which is just bought and sold intraday. It should be a stock, so no to intraday. It should be a stock which is being bought, held for some time, and then sold back into the market. So if this one was on your volume. This one is that volume should translate into transactions and not intraday trades. So these are the four conditions which a stock should comply by for it to be part of traded derivatives as stock derivatives. Order Now, we have talked about in the previous slide what stocks will be part of derivatives trading. There's also an exit criteria in place which talks about if certain conditions are not met, say the previous four conditions are met and certain conditions are not met, then in that case, that specific stock will be asked or will be put up off the derivatives trading. So there are four conditions first of all for that. One is your that stock should be traded by at least 200 members. When I say 200 members, that basically means your trading members. Typically, this will be the rule. This is also alternately defined as or else 15% of the active trading community in that sort of segment. And again, whichever is lower. So practically this will kick in every time rather than the 15% rule. Additionally, it should be active. There should be some sort of minimum trading activity which happens on 75% of the days. Self-explanatory. 75% of the days, there should be some sort of buy and sell orders being put up. So this is who puts the orders. This is when. This is how much. Talks about daily turnover. That the daily turnover for that stock across futures and options should at least be to the extent of 75 crores. And then finally, this talks about open interest. We talked about open interest in one of our previous webinars. Open interest is basically the outstanding contracts. So outstanding contracts across the entire trading book. So outstanding contracts across your trading book. So depending on how many positions were opened and closed, the open interest also varies, and this should be a bare minimum of 500 crores. If these four conditions are not in line, then that particular stock will be exited from the derivative segment, which means that particular stock will be pulled out from the derivative segment and will not be traded on that segment. We talked about when a stock can be part of the derivative segment. Let's talk about how can an index be part of the derivative segment. So first of all, an index would be part of a derivative segment provided 80% of the index constituents itself can and are eligible to be part of the derivative segment. Second, out of the remaining 20%, no single stock or no ineligible stock should have a weightage of more than 5%. Both of these conditions need to be in continuous compliance. Then in that case, that index can be also be part of the derivative segment. Similar to the product success framework or the compulsion of exit from the derivative segment will be determined by these specific rules. We had talked about those four rules on the previous slide for the stock. As far as the index is concerned, these are the four rules. Again, they represent the similar understanding around one around the trading members, around the trading activity, the turnover, and finally the open interest, the same way as we had those rules specified for specific stocks. Say there is two exchanges, A and B, and there's one index which is getting traded on exchange B, but on exchange A it is not getting traded because of certain limitations. It did not sort of comply or was pushed out of the trading on that exchange because of the limits and the continuing parameters which are required to be maintained. Now, since it is not part of this exchange because as an index it's not complying those rules, this index can have an alternative index which so this alternative index which could be included on this exchange provided these conditions are met. When I'm talking about it gets included, what is happening? This specific index can have futures and options on this specific exchange where the original index was not fulfilling all the requirements, and hence an alt index criteria was put into place. And now any which ways this particular framework is known as a surrogate or a pseudo index framework. Now let's look at the three criteria which are to be met. Let's say the larger index has 250 stocks and the alternative index has say 150 stocks. Now the conditions say that the surrogate index constituents must be at least 80% of larger index, which means 80% of the stocks of this 150 should be so 120 stocks should be part of the larger index which is comprising of 250 stocks. So there has to be an absolute overlay or something in common to the extent of these 120 stocks out of these 250 stocks. Second is, it says out of these 250 stocks, at least half of the stocks should be included in the alt index, the alternative index, which is being proposed to be included on this specific exchange. So at least 125 stocks should be, because this is 250, 125 stocks should be part of the alt index, and they should be having an overlap. And finally, the alt index and the larger index should have a correlationship of 0.9, a minimum correlationship of 0.9 over the previous 6 months. Simply put, if these three conditions are met, then this alternative index can be part of this exchange for derivatives trading, which is trading for futures and options on this index, which is the alt index. And this happens because the index in its original form did not fulfill all the criteria which is required to be met for it to be included as a derivative on that exchange. One more quick point: in case any of these indexes or stocks fail to comply by the rules of the the going rules of the requirement of volume, the requirement of how many people should be trading it, so on and so forth, those four specific requirements, if they fail, they'll be put out of the trading on the derivative segment. There will be another cool off period of 6 months, after which you can again evaluate and see if these stocks or indices can be included again or not. So there's once you are part of the derivative segment, After that, if you are removed from the derivative segment, you can again be part of the derivative segment after a cool off period of 6 months, and when you are in compliance with the current existing requirements for 6 months. So that's when you will again be reintroduced into the derivative segment. Corporate actions are actions which change the capital structure of a company. They would range from your stock split, bonus, uh, your rights issuances, or your dividend payouts. Similarly, there can be mergers or demergers of stocks which happen. Uh, all of these corporate actions have an implication on to your cash segment for that underlying. Now, having said that, because of that being the case, that these changes also need to reflect in the derivative market, because derivative market is nothing but a market which is built on top of the underlying, right? So if there is a stock and there are changes which happen at the stock level in the cash segment, that has to also reflect in the derivative segment with those adjustments being made. Now, in a derivative segment, for all corporate actions, calculations are done for these adjustments to also appropriately reflect into the underlying pricing, and the various components such as the strike price, your position size, your market lot multiplier, all of those changes based on these corporate actions. When you buy or sell in the derivatives market, one of course has to deploy amount or the sum of money into the underlying, but additionally there are certain costs involved. So we are focusing just on the costs over here. One are the user charges, which would mean things like your brokerage commission, your exchange transaction charges, so on and so forth. Then are the government levies or levies put up by statutory bodies and the state government and the central government. And finally, there is impact cost, which is nothing but because you are trading, the price might move up or down because you're punching in a volume, and that has a that is in some way already captured into your cost of pricing or cost of purchases of what you make in your futures or options market. But nonetheless, it's specifically also carved out over here in terms of trading cost, that you might also have impact cost, which is the cost, additional cost which might come up because of lack of liquidity. Continuing on with the impact cost, an example here. There's an order book in front of you which has a bid and ask price. The best bid is at 16.6, whereas the best ask is at 16.8. Now, if someone wants to execute a trade, say someone wants to buy, then and say that's a market order, then the price from the current level at which it's bidding, which is 16.6, has to move up to 16.8, right? That's where someone is looking to sell, and hence there is an impact cost. The other way around as well, if someone wants to sell, the best bid is at 16.6. So in case of a market order, which is an order which has to be immediately executed and has to run through the order book, the price which has to be, is being willing to be paid is 16.6, and hence there will be a bit of a distortion. And simply put, this bid ask spread and the impact cost is nothing but takes into account the expense of liquidity, or the expense of looking to liquidate your asset quickly, or looking to basically purchase an asset quickly. And this happens not in limit orders but happens in market orders. What's algorithmic trading? In very simple words, it's basically trading done through the system itself. It's automated. Since it's done by the system, it's high speed, and there are conditions which have been put up, which have been fed into the system, saying that if this happens, subject to these conditions, so on and so forth, the system is supposed to execute these trades. That's basically your algorithmic trading in very short. The reason, it is high speed and it's automated, and is also something which has limited cost associated to it, because institutional investors and large brokers use this type of trades on their overall transactions or overall book, which reduces their current existing cost. So algorithmic trading is something, as has been put up on the caption, it's automated trading using pre-programmed instructions, already defined logics, considering, the logics could be considering price, timing, volume, and they remove all elements of emotion, which is typically involved when you're looking at trades, when you're looking to buy and sell, when there is a profit or a loss in a trade. It removes all of that emotion, and it works in a high speed execution environment. So trading members collectively work as a community, enabling various buyers and sellers. But what happens when one of the trading members, because of some reason, some operational reason, has systems which have become faulty, and which is basically plugged in into the exchanges. It will be a huge situation wherein controls need to be put in, because uh, one sort of one trading member would have a cascading effect on the other trading members as well and their trades, right? Now, hence exchanges have brought together a system called as investor risk reduction access. uh, this particular system, what it does is, in case you feel that there is a disruption which has been caused by one of the trading members, one, the investor at their own end can log in to the exchange and straight away put commands around their current order book to the exchange through this particular platform. These commands around trades have all to do with the fact that they should be trying to reduce the exposure. They should be looking to reduce the current limits which are getting used by them, and they should be into the risk reduction mode. Uh, Finally, there is an admin terminal access as well. Trading members monitor these investor actions and can execute the instructions and accept it based on the commands which have come in from the investors on this specific portal, this specific platform, which is known as the IRRA. And this is specifically to de-risk against any specific trading member facing technical glitches or facing operational issues. To market settlement. So mark to market is your daily adjustments made to the margins, wherein additional margins are expected to be brought in, or the margins are credited, or your profit and loss on the position is shared, and you can use the freed up margins for trades the following day. So let's look at one example, just to understand how this is computed, and how it is done on a cycle by cycle or a day by day basis. So first of all, your say you are at the close of the day, and there is price calculation to be done. This price calculation is done based on the trading volume in the last 30 minutes and the prices. So for example, there will be certain number of trades which will be done across through the last 30 minutes, and there will be so this is your volume, and then there will be a price at which each of these trades has been done on a weighted average basis, which is some product basically from a formula standpoint. On a weighted average basis, you will come across to a particular price, which will be the weighted average across exchanges for the last 30 minutes. The specific price is computed for that underlying, for that particular derivative. This price is used for the profit and loss computation. So this price is also known as the settlement price for that specific day, and it is compared to your price, which is your trade price. Any difference between the two will result into profit or loss. This profit and loss computation is picked up, and margins are your margin, which is there, is either released or brought in. This these margins are to be there within the system in terms of either released or brought in before the next trading day. When the next trading day starts, your since you have already adjusted for that between difference between the trade price and the settlement price becomes the settlement price for the previous day becomes the point from which you will again start this entire cycle of M to M. So this basically your settlement price would again be compared to the price calculations for the next day. This price calculation would help you derive the profit and loss, wherein the settlement price over here comes in from the price calculation, whereas the trade price is but nothing but your previous day's settlement price. And this has to be, the margins have to be either be released or brought forward before the start of the next day, and this cycle continues on and on till the time you are closer to your final settlement date, which is the settlement date as per your futures and options. As for options are to be considered, the margins for an option are brought only by the option seller. There are no margins for an option buyer. The reason is an option buyer pays premium, and an option buyer can lose only to the maximum extent to the option premium which has been paid. All this has been covered. All options basically are settled on a T+1 clearing, through the clearing banks. We referred to the settlement cycle as to how the prices are computed. First of all, a cash position, or sorry, a profit and loss position is computed. The margins are either released or brought in into the account of the specific individual, and then the settlement price is compared or is made available to and sort of recalibrated for the next day. So those were the four steps which we looked at when we are discussing. The four steps will also be taken into account over here. Another thing around options is that an option which has intrinsic value, it gets automatically exercised on the settlement day. So an option which and see, I mean, this, when I say settlement day, practically I'm referring to the fact that options has two types of values. One is your intrinsic value and second is your time value. On the settlement day, your time value becomes zero. So your intrinsic value is basically the value which the option has. When it is in the money, these options are automatically exercised and they are assigned to other short positions and settled. Finally, in terms of settlement, settlement and settlement calculations, index options cannot be delivered. Why? because an index comprises of so many stock that you really cannot deliver an index option to the other counterparty. They are always cash settled, and that too at the intrinsic value. As for stock options, they are, they can be settled using stock, and there is physical delivery which is expected, which is, I mean, when I say physical delivery, it's basically electronic delivery. It means delivery of that specific stock, getting subtracted from your account and getting added to someone else's account at the strike price. So why the strike price? Because this is nothing but in other words, the pre-agreed price at the initiation of the contract. This covers our lecture for today, which has covered various aspects around the derivatives market and largely around the trading mechanism. We will now move into a very small quiz of just two questions. And once you have given that quiz, we'll just discuss those two questions and we'll be done through the day. So before moving on to the quiz, I can see a couple of questions. In fact, one question there from Mahesh, who has asked as to what's algo trading, when does it get used? So see, I mean, algo trading is the word. It is algorithmic trading. In other words, you can also say it's automated trading. Some other ways to explain it is it's a black box trading. What it does or says is it is a computer program which has preset rules on when to trade and what to trade in what sort of level and so on and so forth. So there will be information which flows into the system. There will be various trading rules put in, that in case of this, that, and so many conditions attached, one would automatically execute those trades. Now, algo trading is useful for places where it is not humanly possible to trade based on certain rules. So, you define those rules, and to execute it, it's not humanly possible to, do it, because at times, again, the information changes, market moves. If you take maybe even 30 seconds, information, because of the change in information, change in prices, things, and you will not be able to execute the trade. So algo trading is only useful for people who are doing rule based trading, and it is used for high frequency trading. Now, having said that, it is used for high frequency trading. Rules need to be very clearly defined, because if rules are not clearly defined and the trading happens, it can lead to significant changes in the market price. You will also have SEBI fines which can come in, saying that you were manipulative and you manipulated the market. And all of the rules which are defined, first of all, also require an approval from exchange and approval from SEBI that this is fine to be executed. So when you put in a code into a system saying that this is the basis in which I will be doing an algo trading, you actually also need to get it approved, so that you are not affecting the broader market as such. So that's algo trading. There's also substantial risk management which is required, because algo trading can swing the market, or can have impact cost, can sort of erode off the entire order book very quickly on the buy side, on the sell side, and hence it is something which is very closely monitored. Having said that, I don't see any other questions. So we will just move ahead and go to the quiz section. It's a short quiz of two questions only. Please publish it.
So brief, an apology from my side. I think the questions which were displayed on the screen were slightly different from the two-question quiz which we had. I'm sure you guys have already sort of gone through the quiz, and while I see at the response monitor, I can see that most of you have got a chunk of the questions as correct. So that's, I think, good for us from an audience standpoint. Now, Pradeep, please move ahead onto the final slide. So the correct answers is one's correct. The answer to question number one is A, which is true. So simply put, your trading system will only, which will be the price of buying the underlying and not the entire cost. Hence, one of the slides actually talked about what are the other costs involved in purchasing, which had cost like brokerage, had cost like levies, and had also there was also a third component which was mentioned there. I think that was to do with so one was commissions and brokerage, second was levies, and the third one was there, which was on the slide. So all those costs associated are not put up onto the trading screen. And again, based on any individual relationship with the trading member, these costs will also vary. Someone might be getting charged a preferential rate based on the volume which the person or the investor provides to the trading member, right? So the correct answer is A. As for question number two, a trader has bought 100 shares at 780. The person does not want to make losses of more than 1,000. So simply put, the person can make a loss of 10 rupees per share. Now, this is very simplified because you are avoiding or you're not looking into any other cost involved. While nothing has been mentioned about brokerage, STT, and so many other things which are part of the additional cost. So we'll assume there are none. In that case, this person, since he bought at 780 and can take a maximum cost of 1,000 in absolute with 100 shares, which means 10 rupees on every share. So the person can go down to only 770 in terms of their losses. They have to liquidate the position at 770 to ensure that the loss is not more than 1,000. So if you just look at the options A, B, C, D, it's just option A, B, and D which are having the number 770. Now between the types of orders, there's limit sell and limit buy. This is not really a limit order, but this is actually a stop loss order because you would like to just exit the position at the maximum of 770's price. So the correct answer is option B. With that, we have concluded today's session. We will be having two more webinars around equity derivatives, and this will be followed up in the next week on Tuesday and Wednesday. I look forward to seeing you then. Thank you very much for your time.